January 24th, 2026, $5,009 per ounce. That is the price level gold touched this morning before pulling back to settle near $49.87. This is not a correction. This is not profit-taking. This is the sound of a 100-year-old monetary system fracturing under its own weight. But you're not looking at the right metal. While the world watches gold break through psychological barrier after psychological barrier, silver just crossed $102 per ounce, rocketing over 6% in a single trading session, 42% in a single month, and an almost incomprehensible 234% year over year. The financial media will tell you this is industrial demand. They will cite solar panels and electric vehicles and artificial intelligence infrastructure. They are not lying, but they are not telling you the truth. The truth is far more dangerous. What you are witnessing right now is not a bull market. It is a liquidity crisis disguised as a price discovery event. And the banks selling paper silver contracts have just run out of time to cover their positions. The Hunt brothers tried to corner the silver market in 1980. They owned 1/3 of the world's privately held silver and drove the price from $6 to nearly $50 in a matter of months. The squeeze happened because they took physical delivery of their contracts, leaving paper shorts with nothing. History is not repeating, it is detonating. The Hunt brothers of 2026 are not two wealthy Texans. They are China, the solar industry, Russia, and European central banks themselves. And unlike 45 years ago, this time, the short sellers cannot call the government to change the rules in their favor. On January 1st, 2026, China implemented export licensing restrictions that severed the primary artery of global refined silver supply. Only 44 firms with annual production capacity exceeding 80 tons and credit lines above $30 million can export silver from the nation that refines 65% of the world's supply. This is not trade policy. This is economic warfare conducted through commodity control. And it worked. Physical silver in Shanghai is trading at $8 to $10 above Western benchmarks. Chinese buyers are paying premiums to hoard metal before it can leave their borders. They are not speculating. They are preparing. Now we need to talk about what Basel III just did to the global banking system. For decades, banks could count unallocated paper silver as a safe capital asset. They could sell promises of silver they did not own, suppress the price through derivatives markets, and laugh all the way to their fractional reserve vaults. Basel III, the international banking regulatory framework that went into full effect this month, reclassifies unallocated precious metals as toxic. Physical gold and silver are now Tier 1 assets, equivalent to cash and government bonds with a 0% risk weighting. But paper silver, the derivative contracts, the futures, the unallocated accounts, they now carry an 85% required stable funding factor. In plain English, banks must set aside 85 cents for every dollar of paper silver exposure, making it economically unviable to hold. European banks, hit with these rules on January 1st, are scrambling to convert paper positions into physical metal to meet liquidity requirements. The problem is simple and catastrophic. The metal does not exist. London vaults held 850 million ounces of free-float silver in early 2024. By October of last year, that number had collapsed to 200 million ounces, a 75% decline. Some estimates put available metal closer to 150 million ounces. Meanwhile, COMEX registered inventories in the United States are down nearly 70% since 2020. Shanghai inventories have fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. You're watching the bank vault run dry in real time. This brings us to the most dangerous signal in the entire financial system right now: backwardation. In a normal commodity market, future prices trade higher than spot prices because of carrying costs, storage, insurance, and time value. When spot prices trade above futures, the market is screaming that physical delivery is more valuable than waiting. Silver futures have been in backwardation for months. Traders are rolling contracts backward from March to January and February, demanding immediate delivery instead of maintaining paper exposure. Open interest data from January 7th shows a surge of over 1,400 contracts rolling into January and 1,500 into February, while March, open interest collapsed by nearly 3,000. This is not hedging, this is panic. Longs positioning aggressively to stand for immediate delivery are draining COMEX-registered stocks. If shorts are involved in the roll, they are attempting to avoid delivery demands by shifting earlier. Both scenarios are existential threats to the exchange. The entire pricing mechanism is fracturing because the underlying assumption that made paper markets work has failed. That assumption was simple. Nobody would ask for delivery all at once. They were wrong. On December 27th, silver futures gapped higher from $72 to over $74 on the Globex reopening after Christmas. At 8:30 that Friday morning, the first signs of major stress appeared. Two big-to-fail banks tapped the Federal Reserve's repo facility for $17.25 billion in emergency liquidity. As trading progressed, silver exploded 11% higher in a single session, from $71 to nearly $80. In Shanghai, the metal closed even stronger at $85. Later that afternoon, rumors circulated through trading desks that a large bullion bank was unable to meet a massive margin call it had just received on its naked short silver position. At exactly 3:52 p.m. Eastern Time, someone placed a $429 million directional bet on the SILJ Silver Junior Miners ETF, with the majority of contracts expiring in just 3 weeks. This was not speculation. This was informed positioning. If a bank knew it could not meet its margin call in 8 minutes and knew its legacy short position would be liquidated the moment silver futures resumed trading Sunday night, and knew that liquidating its massive naked short would trigger the mother of all short squeezes, what would it do? It would attempt to save itself from insolvency by placing a massively leveraged long bet on the very miners that would explode when its own short position got force liquidated. You are watching Wall Street cannibalize itself. The paper market and the physical market have officially decoupled. While COMEX futures quote silver at prices around $70 to $80, physical silver in Tokyo and Dubai is reportedly changing hands at premiums as high as 80%, with some transactions reaching $130 per ounce. This is the largest divergence in the history of precious metals trading. It signals a fundamental breakdown in the pricing mechanism that has governed the silver market for decades. Industrial users in semiconductors, electric vehicles, and solar energy are bypassing Western exchanges entirely to secure physical metal at any cost, fearing total depletion of available inventories. The COMEX is now bracing for the possibility of a force majeure declaration. If the exchange officially admits it cannot fulfill physical delivery requests, the paper price of $70 would likely collapse or cease to exist as participants flee to the physical market. This would lead to a gap up where the paper price suddenly aligns with the $130 physical reality, potentially overnight. Strategic pivots are already underway. Industrial users are signing long-term supply contracts directly with miners, bypassing the traditional exchange system altogether. The market is bifurcating into two worlds, one where silver exists physically and one where it only exists on paper. This is where the system breaks. Gold is trading near $5,000, silver is trading over $100, and the gold-to-silver ratio has compressed from over 100 to 1 in April of last year to approximately 57 to 1 today. That compression tells the story of silver's explosive outperformance, a 147% gain for silver versus 67% for gold. But here is what the ratio is not telling you. Historically, the gold-to-silver ratio has oscillated between 50 to 1 and 80 to 1 in modern markets. In ancient civilizations, it was fixed at 12 to 1 or 15 to 1. During the 1980 inflation scare, the ratio fell to nearly 20 to 1. If the ratio were to revert toward those historical extremes, silver would need to rise to between $150 and $330 per ounce at current gold prices. But gold is not staying at $5,000. Forecasts for this year range from $6,000 to $8,000. If gold reaches $8,000 and the ratio compresses to 30 to 1, silver would trade at $266. If the ratio reaches 20 to 1, silver would be $400. This is not speculation. This is mathematical necessity, driven by supply destruction, regulatory compliance, and the death of paper pricing mechanisms. The global silver market has run in structural deficit for 6 consecutive years. Cumulative shortfalls from 2021 to 2025 total roughly 820 million ounces, nearly equivalent to a full year of global mine production. In 2026, the deficit is expected to reach 200 million ounces. Without new supply channels, major new mine projects, or a step change in recycling technology, this deficit will inevitably squeeze prices higher. Primary mine production sits at approximately 810 million ounces per year. Recycling contributes 180 to 190 million ounces, mostly from industrial scrap and end-of-life electronics. Annual demand from photovoltaic solar panels, electric vehicles, AI data centers, and electronics far exceeds new supply. Industrial consumption alone accounts for 60% of total global production. And now you have central banks, sovereign wealth funds, and strategic reserve programs entering the market as buyers, not sellers. Russia allocated over $500 million to silver reserves in their 2025 to 2027 budget. The United States and European Union have both designated silver as a strategic mineral. This is no longer a commodity, it is a national security asset. And when governments start hoarding, the private market starves. Let us be clear about what holding cash means in this environment. The US dollar index sits around 98 to 99, down 0.6% weekly after rebounding from recent lows. The dollar gained some short-term strength after Trump softened his tone on European tariffs at Davos, but the structural picture is collapsing. With the Federal Reserve under criminal investigation, including probes into Chair Jerome Powell over headquarters renovation spending, confidence in fiat currency is eroding. Expectations of steady rates may support the dollar in the very short term, but they are simultaneously fueling inflation fears that drive capital into precious metals. The dollar is not strong. Everything priced in dollars is being destroyed. When gold rises 80% in a year, that is not gold going up. That is the dollar losing purchasing power at a catastrophic rate. When silver rises 234%, that is not industrial demand. That is the market screaming that paper currency is worthless. You're not watching inflation, you're watching debasement, and the difference matters. Inflation is when too much money chases too few goods. Debasement is when the currency itself loses credibility as a store of value. And that is the regime we have entered. Bitcoin, the supposed digital safe haven, the inflation hedge, the store of value that was going to replace gold, it is hovering near $89,000 to $92,000, down 28% from its $126,000 peak in October of last year. It failed to hold $94,000. It broke below key moving averages. It faced $600 million in liquidations amid risk-off sentiment. While gold and silver explode to all-time highs, Bitcoin is trapped in sideways trading between $88,500 and $90,500, with support barely holding at $90,000. This is the most important divergence in modern finance. When risk assets and safe havens both rise together, that is liquidity. When safe havens rise and risk assets fall, that is fear. When physical assets decouple from digital promises, that is the end of trust. Bitcoin is a narrative. Silver is an atom. And in a world where delivery matters, atoms win. Time itself has become the enemy. Settlement delays, delivery failures, cash settlements forced by exchanges unable to source physical metal. The CME has already hiked margin requirements multiple times to calm late 2025 leverage. Rule 589 allows dynamic price bands, trading halts, expanded limits, or emergency cash settlements during volatility spikes. These tools prevent total breakdowns, but they also expose the lie. If the exchange can simply cash settle a delivery demand, then the price was never real. It was always a promise backed by nothing. And now that promise is being called. The banks that sold billions of ounces of silver they never owned are running out of time. They cannot buy the metal fast enough, they cannot cover their positions without driving the price vertical, and they cannot declare force majeure without triggering a systemic crisis of confidence in every derivative market on Earth. They are trapped, and the clock is ticking. This is not a trade, this is a turning point. The financial system you grew up with, the one where central banks could print forever, where paper contracts could substitute for physical assets, where price discovery happened in futures pits instead of vaults, that system is dying. It is being replaced by something older and more honest. A system where if you do not hold it, you do not own it. A system where physical scarcity defines value. A system where governments and industrial giants fight over the same limited pile of metal because there is no substitute. Silver is not rising because people believe it will go higher. Silver is rising because the alternative is worse. Holding cash guarantees loss. Holding paper promises guarantees betrayal. Holding Bitcoin guarantees volatility with no physical backing. Holding silver, real silver, deliverable silver, means you own something that cannot be printed, cannot be confiscated electronically, and cannot be created by central banks. It is the only asset in the world right now with triple identity. Industrial input, monetary metal, strategic material, and all three demand curves are spiking simultaneously. The banks have 78 days until the end of March to comply with Basel III capital requirements. They need hundreds of millions of ounces of physical silver. The market has maybe 150 million ounces of available float across all global vaults. Do the math. This is not a squeeze. This is a mathematical inevitability. The price will continue rising until either demand is destroyed or supply is created. Demand cannot be destroyed because industrial users need the metal to function. Solar panels require silver. AI data centers require silver. Electric vehicles require silver. Nuclear reactor control rods require silver. This is not discretionary. Supply cannot be created because mining takes years to scale and recycling cannot close a 200 million ounce annual deficit. The only variable left is price, and price will rise until equilibrium is restored. That equilibrium is not $100. It is not $200. If the fundamentals hold and the paper market continues to fracture, the equilibrium price for silver in a world of $6,000 gold and strategic mineral designation could be anywhere from $300 to $500 per ounce. Some analysts, looking at historical ratios and monetary debasement, are whispering about four-digit silver. Whether that happens or not, what is undeniable is this. We are watching the most severe supply crisis in modern commodity history unfold in real time. And the people who bet against physical scarcity are about to learn a lesson that will rewrite textbooks. You are standing at the edge of a regime change. The old rules no longer apply. The paper game is over. The scramble for real things has begun. And doing nothing, holding cash, trusting the system, waiting for clarity, that is itself a decision. It is a decision to let your purchasing power be destroyed, while those who understand what is happening move their wealth into the only assets that cannot be debased. The warning has been given, the system is fracturing, the clock is running, and the banks are trapped.